At some point in the last few years, investing stopped feeling like research and started feeling like live entertainment. Charts don't move, they explode. Stocks don't rise, they teleport. And somehow, everyone online seems to be turning $500 into the GDP of a small island nation overnight. It's fun to watch, it's chaotic, it's addictive. But it's also a little terrifying. Because markets weren't always like this. For decades, investing was simple. Not easy, but simple. You looked at earnings, you studied revenue growth, you compared valuations, you asked one boring but powerful question. Is this business actually worth this price? That question used to matter. Now it feels optional. Since 2020, something shifted. Stimulus checks flooded the system. Interest rates dropped to near zero. Trading apps made speculation frictionless. Memes became market catalysts. And suddenly, the market wasn't just a financial system, it was a social network with a buy button. Companies with no profits were worth billions. Bankrupt stocks rallied. Weekly options became lottery tickets. And fundamentals? They felt like background noise. Now here's the important part. This isn't the first time markets have gone wild. We've had the dot-com bubble, we've had the housing bubble, we've had cryptomanias and commodity crazes. Speculation is not new, but what feels different now is speed. Narratives form in hours, trends go viral in minutes, and capital moves at the speed of Wi-Fi. The market used to be influenced by earnings reports. Now it's influenced by engagement metrics. And when prices detach from profits long enough, a dangerous belief starts forming. Fundamentals don't matter anymore. But here's the thing about gravity. It works whether you believe in it or not. Cash flow still matters. Profitability still matters. Debt still matters. You can ignore them during a liquidity boom. You can mock them during a speculative frenzy. But eventually, valuation shows up. Not dramatically, not with a warning label, just quietly, through compression, volatility, and reality. And when that happens, the investors who treated markets like a casino discover they weren't the house. So what changed? First, liquidity. When money is cheap, risk looks smart. Second, accessibility. Anyone can trade anything instantly. Third, psychology. We've gamified finance. Notifications replaced patience. Screenshots replaced strategy. And the biggest shift of all? The goal stopped being ownership of businesses. The goal became momentum capture. Now don't misunderstand this. Innovation is real. AI is real. Technology growth is real. But valuation still sets the long-term ceiling. You can overpay for the best company in the world and still get poor returns. That's the part most people forget. Markets can stay irrational longer than you expect, but they cannot stay detached from economics forever. So maybe the smarter question today isn't which stock will 10x next month. Maybe it's, if speculation disappeared tomorrow, would I still want to own this? Because eventually, always, the party music fades. And when it does, fundamentals are still there, waiting. The market hasn't stopped working, it's just louder than it used to be. And in noisy markets, discipline becomes a competitive advantage. So, while everyone else is spinning the wheel, you might want to check the math.